Okay, what if I told you that a staggering 82% of businesses actually don't fail because they have a bad product? I know, it sounds totally crazy, right? But it's true. The stark reality is that they fail because they simply run out of money, not because their ideas are flawed.
And that brings us right to an incredibly punchy golden rule you absolutely need to remember. Cash flow is king. Why? Well, because a business can look like a massive success on a spreadsheet, and you could have the most fantastic product in the world, but you can still fail entirely if you just don't have enough actual cash in the bank to pay the bills.
So, welcome to today's explainer, where we're going to demystify the numbers using a foundation to fortress approach. Whether you're launching a brand new startup or just looking to sharpen your competitive edge, understanding business finance is the secret weapon. It is literally what separates the highly successful founders from the ones who, well, just had a good idea.
Here is our game plan. We'll be covering mastering core finance terms, reading financial statements, managing budgets, capital and growth, and finally, tools for enduring success.
Let's jump right into Section 1, Mastering Core Finance Terms and Laying the Foundation. At its very core, business finance really isn't magic. It's simply the process of managing your money to keep the lights on and keep growing. So let's break down the two most essential terms you're ever going to use: revenue versus profit. Now, revenue is the total money your business earns. Profit, on the other hand, is what's left after all your expenses are paid. So to put that in perspective, if your business earns $10,000, but you spend $7,000 just to operate, your crucial profit is $3,000. That $3,000, that is what actually matters. Next up, we have assets versus liabilities. Seeing finance as a balancing act is super key here. Assets are the things your business owns, like equipment, inventory, or cash. Liabilities are the things your business owes, like loans or outstanding vendor bills. You've got to watch these because liabilities act like an anchor that can literally sink your assets if left unchecked. Oh, and while we're talking about what you own and owe, let me highlight an absolutely crucial habit. Never, ever mix your personal and business money. Keeping them completely separate is just fundamental to clear accounting. Then there's working capital. Think of working capital as the essential fuel you need to keep your business engine running smoothly every single day. It's the cash you need right now, today, to keep operating without a hitch, which is very different from your long-term investments. Moving on to Section 2, reading financial statements, which is really your financial dashboard. Think about it. You would never drive a car blindfolded on the highway, right? Well, you absolutely shouldn't run a business without reading your dashboard dials. First up is the profit and loss statement. This is basically your speedometer. It shows your revenue, expenses, and ultimate profit or loss over time. Second is the balance sheet, which is your fuel gauge, giving you a snapshot of exactly what your business owns and owes at a specific frozen moment in time. And third, the cash flow statement. This is your engine temperature, tracking the actual physical money moving in and out of your accounts. These three pillars track the absolute health of your entire enterprise. Let's look a bit closer under the hood at your profits. You've got gross profit versus net profit. Gross profit is simply the money left over after your direct costs are removed. But net profit, that's the big one. That is the ultimate bottom line. The money left after absolutely all expenses are paid, down to the very last paperclip or coffee filter. And speaking of direct costs, you cannot ignore your cost of goods sold, or COGS. This represents the unavoidable direct materials and labor required to actually make what you sell. You have to know this number inside and out to even know if your product pricing makes sense. So once you've calculated all of that, you're left with your operating profit, which is your profit before taxes and interest are taken out, and eventually your retained earnings. Retained earnings are fascinating because they act as your saved power. It's the fuel kept inside the business for future expansion. It's basically your financial war chest for growth. All right, Section 3, Managing Budgets, the Engine of Growth. Now that our foundation is set and we know the terminology, we're building the framing of our fortress. A budget is simply a financial plan based on your estimated income and your expected expenses. But you've got to separate your fixed costs, which are those rigid bills you always have to pay regardless of how much you sell, like rent, from your variable costs. Those are the fluctuating costs of doing business, like materials and shipping. Managing a budget successfully means predicting exactly how these two variables interact as you scale up your operations. And that leads us to a reality I really want to let sink in for a second. Small leaks can sink a big ship. So many founders are looking out for this massive iceberg, but it's usually a dozen tiny leaks, like forgotten recurring software subscriptions you never even use, that actually sink the ship. Tracking every single expense is how you patch those tiny leaks before your business goes under.
Now, to survive the leaks, you must find your break-even point. This is the exact point where your revenue perfectly equals your expenses. At this milestone, you aren't making money yet, but hey, you aren't losing it either. It's also exactly why building an emergency fund is so absolutely vital. You need a cash cushion to handle the unexpected stuff before you hit that beautiful break-even mark.
Let's hit section 4, capital and growth, fueling your business. Capital is the essential money used to start, operate, or grow a company. When it is finally time to scale up, you've got a menu of options. You can bootstrap and self-fund, take on traditional business loans, pitch to angel investors or venture capitalists, or even launch a crowdfunding campaign. But hear me clearly on this. Before you take a single dime from any of these sources, you must have a rock-solid financial plan in place. You have to know exactly how much you need and exactly how you're going to use it to grow. Which brings us to the ultimate golden rule. It's the most important question every smart entrepreneur has to ask before spending a single cent. If I spend this money, what return can I realistically expect? This is your return on investment, or ROI. Never, ever spend capital without asking yourself this question first.
You also have to understand how you are securing that money. It usually comes down to debt versus equity. Debt means borrowing money that must be repaid, usually with interest, right? Equity means giving away a share of ownership in your company. Both of these carry serious emotional and financial weight. Too much debt threatens your bank account and gets dangerous fast, but giving away too much equity threatens your control over your own vision. Smart entrepreneurs know exactly how to strike a careful balance between the two.
Finally, section 5, tools for enduring success, building long-term wealth. Look, mastering business finance isn't about becoming a certified accountant. It's really about leveraging technology to upgrade from basic bookkeeping to actual wealth creation. Instead of drowning in spreadsheets, modern founders automate. Whether you're using QuickBooks for your accounting, Stripe to process payments seamlessly, or Gusto for payroll, relying on a dedicated tech stack drastically reduces human error and saves you massive amounts of time. That way, you can focus on what you actually do best, growing the business. But tools are completely useless without a strategy. You have to build a timeline of habits, like sitting down and reviewing your finances every single week. Short term, you ensure the bills are paid. Medium term, you focus on actively increasing your sales volume. And finally, long term, you set your sights on expanding into brand new markets. The more financially educated you become, by reading books and taking courses, the stronger your business is going to be. And that brings us to our final thought for today. When you master these dials, accurately manage your budget, and wisely leverage both capital and modern tools, you realize something pretty profound. You're no longer just running a business. You're building a wealth-generating machine. So I want you to ask yourself, are you currently building a financial fortress, or are you just bailing water out of a leaky boat? Patch the leak today, and I'll see you in the next explainer.